Smart investing isn't about chasing the hottest stocks or timing the market perfectly. It's about having a plan. In a world flooded with hype, memes, and financial noise, those who succeed are the ones who follow strategy over emotion. If you've been saving money but don't know how to grow it, or if you've been dabbling in the market without seeing real results, let's clear up a myth. Smart investing is not about being lucky or having inside information. It's about having a repeatable long-term strategy that works across market cycles. Whether you're investing in stocks, ETFs, crypto, or real estate, it all comes down to how well you manage risk, stay consistent, and avoid emotional decisions. Strategy gives you a framework, so you're not reacting to every market headline. It also protects you from self-sabotage, panic selling during crashes, or FOMO buying during hype. Smart investors focus on what they can control: fees, diversification, contribution amounts, and holding periods. Luck might make someone rich fast, but strategy is what keeps them wealthy. You can't create a smart strategy without first knowing what you're aiming for. Are you investing for retirement at 60? A home in 5 years? Passive income by 40? Your goals define your roadmap. A long-term goal allows you to take on more risk and ride out volatility, while short-term goals require safer, more liquid investments. Be specific. Instead of saying, "I want to build wealth," say, "I want to grow $20,000 into $100,000 in 10 years. Clear goals guide your asset allocation, time horizon, and risk management. Without a target, you'll drift. With one, you'll invest with intention and direction. No matter how confident you are in a stock or sector, never bet everything on it. Diversification is your first line of defense against market surprises. When you spread your investments across different industries, regions, and asset classes, you reduce your exposure to any single point of failure. For example, if tech stocks crash, your real estate ETFs or bond funds might hold steady. Even diversified index funds, like the S&P 500, give you exposure to hundreds of companies at once. It doesn't guarantee gains, but it minimizes catastrophic losses. Think of diversification as the seatbelt of investing. You hope you never need it, but you'll be glad it's there when things go wrong. Trying to wait for the perfect moment to invest usually leads to procrastination, or worse, buying at the top. That's why smart investors use dollar-cost averaging, investing a set amount at regular intervals, like $200 every month. This approach removes emotion and market timing from the equation. You naturally buy more shares when prices are low and fewer when they're high, automatically improving your average entry price. It's especially useful during volatile markets. Set it up through your brokerage, automate the deposits, and forget about trying to guess the market. The most boring investment habits are often the most profitable. If you look at a one-year stock chart, you'll see chaos. Zoom out to 20 years, and you'll see upward momentum. That's why smart investing is about patience and perspective. When markets crash, it's tempting to sell. When stocks soar, it's tempting to chase. But the best investors ignore the noise. They understand that short-term pain is often the price of long-term growth. Holding for years, not months, gives your investments time to grow, recover from dips, and compound. The truth, time, not timing, is what builds wealth. The longer your money stays invested, the harder it works for you. Many beginners want to pick the next Amazon or Tesla, but smart investors know the safer bet is owning the entire market. That's exactly what index funds do. An S&P 500 ETF, for example, gives you exposure to 500 leading companies in one investment. Index funds have low fees, instant diversification, and strong historical returns. They don't require constant monitoring or research. Even legendary investor Warren Buffett recommends index funds for 99% of people. Why? Because most active traders underperform the market. Index investing is simple, proven, and perfect for building long-term wealth, especially for busy people. A smart way to balance risk and growth is by following the 80-20 rule. That means putting 80% of your money into safe, diversified investments like index funds, bonds, or dividend stocks, and the remaining 20% into higher-risk, high-reward assets like growth stocks or crypto. This strategy gives you a stable core that grows over time, while still leaving room to chase some upside. You can adjust the percentages based on your risk tolerance or stage of life. But the idea is to protect the majority of your money while giving the rest space to grow faster. It's risk-controlled. If your investments pay dividends, don't just cash them out, reinvest them. This strategy is called a dividend reinvestment plan, DRIP, and it allows your portfolio to grow faster by buying more shares automatically. Think of it as compound interest on steroids. The dividends you earn buy more shares, which then earn their dividends, creating a snowball effect. Over the decades, this can add tens or hundreds of thousands to your returns. Reinvesting dividends doesn't just boost your portfolio, it helps you stay consistent and avoid emotional decisions. Smart investors let their money grow silently in the background while they focus on life. Trying to predict the market is a losing game. Even the best analysts get it wrong. Instead of trying to buy low and sell high, focus on staying invested consistently. Missing just the 10 best days in the market over 10 years can drastically cut your returns. That's why smart investors don't try to time crashes or wait for the perfect dip. They stay invested through highs and lows. The best strategy is often the simplest. Invest early, invest regularly, and hold. As they say, it's not about timing the market, it's about time in the market. You wouldn't give away 10% of your paycheck every month, so why do it with your investments? High fees, even 1 to 2%, eat away at your returns year after year. Smart investors choose low-cost index funds, fee-free brokerages, and platforms that don't charge hidden transaction costs. Over 30 years, avoiding just a 1% fee can mean tens of thousands of extra dollars in your account. Always compare the expense ratios of funds and avoid flashy investment products with high management fees. In investing, every fraction of a percent matters when it comes to building wealth. Even if you start with a perfect portfolio, markets shift. One asset class might soar while another lags. That's why smart investors rebalance their portfolios once or twice a year. Rebalancing means adjusting your asset mix back to your original plan, selling a little from what's grown too large and buying what's lagging. It helps you maintain your desired risk level and avoid overexposure to any one sector. And it trains you to buy low and sell high, the exact opposite of what most emotional investors do. Rebalancing is a quiet strategy that delivers powerful results over time. Taking profits is not a failure, it's part of the plan. If one investment grows to dominate your portfolio, it may be time to trim it and reallocate. Smart investors know when to take money off the table and lock in gains, especially if it helps them meet a financial goal. Selling with intention, like for a home, retirement milestone, or major purchase, is smart. Selling out of fear or greed is not. The key is to have an exit strategy, just like you had an entry one. Profits mean nothing until they're used wisely. One of the smartest ways to build wealth is through tax-advantaged accounts like 401ks, Roth IRAs, and HSAs. These accounts either let your investments grow tax-free or delay taxes until retirement. For example, a Roth IRA allows you to withdraw earnings tax-free after age 59 and a half, while a 401k gives you tax-deferred growth and potential employer matches. HSAs even offer triple tax benefits if used for healthcare. By investing in these accounts first, you maximize your returns and legally keep more of your money. Smart investors build their wealth efficiently, not just aggressively. Staying educated is smart. Obsessing over every headline isn't. Read a few reliable sources, watch a couple of quality finance channels, and check in on your portfolio monthly. That's all you need. Overexposure to financial media leads to fear-driven decisions and reactionary investing. Choose long-term thinking over daily market noise. And remember, Being informed doesn't mean changing your strategy every week. Smart investors learn continuously, but they act only when necessary. The smartest strategy is the one you can stick to. Don't copy your favorite YouTuber or Reddit trader. Build a plan that reflects your income, risk tolerance, lifestyle, and goals. Maybe you're aggressive and growth-focused, or maybe you prefer slow, steady income. There's no one-size-fits-all approach. What matters is that your strategy is realistic, sustainable, and clear. Review it once a year, adjust when your life changes, but above all, own it. Because the best investing strategy in the world means nothing if it's not aligned with who you are. Smart investing is about playing the long game with discipline, not drama. It's about making simple, repeatable decisions that add up over the years, not chasing shortcuts that disappear in days. If you're ready to take control of your money, your future, and your freedom, then you're already ahead of most people.